we have Mark Henderson, who's going to talk you through what's been happening. So without further ado, I'll hand over to Mark.
Good evening. Thank you very much for taking the time to come and listen to the Sirius story. My name is Mark Henderson. I am CFO designate, so my appointment is contingent on approval in the coming general meeting, so I better do a pretty decent job here this evening. So, Sirius Petroleum, many of you, I guess, probably know about the company already. Who and what is Sirius Petroleum? Sirius is an AIM-listed company, roughly $35–40 million market capitalization. The company is focused essentially on developing discovered oil and gas assets, ideally in shallow waters offshore Nigeria. So Nigeria is the principal focus of the company. At the moment, we are a single asset company. In October 2011, we farmed into the Aurora field in OML 95. OML 95 is part of a major Chevron producing complex in the northern part of the Niger Delta. Originally, the Aurora field was drilled in 1986 by Chevron, or Gulf Oil as it was then. The Aurora 1 well tested 2,800 barrels a day. The asset was drilled in 1986, as many of the majors at the time had a lot of acreage and were forced by the government to drill wells just to retain that acreage. There were a lot of these discoveries made at the time, many of them around that 2,500 to 3,000 barrels a day. It was probably too small at that time for Chevron to be bothered developing. You probably remember oil prices were very low as well. So in the interim, the government took back quite a few of these licenses where these smaller discoveries had been made, and they issued those assets out to indigenous companies under the marginal field bid round process in the year 2003. The Aurora field was taken on by our partners, Owina Oil and Gas, which is the state-owned entity of the Ondo state, one of the 10 producing states in Nigeria, and Guarantee Petroleum. We farmed into that asset in 2011 under a financial, technical and service agreement. So we operate the asset, we're responsible for funding the activity, we have the right to market all the hydrocarbons, but we're also responsible for funding the work program as we go forward. Just about 6 months ago, a company called Rock Flow Resources published a CPR and attributed a NPV 10 of roughly $60 million to the 24 million barrels of oil equivalent of 2C contingent resource on the field at $50 oil. Just to give you an indication, every additional $1 in the oil price adds about $2 million to the NPV net to us as a company. Over the course of the last couple of years, in what has been a very difficult funding environment for the industry, we sat down with quite a few of the larger service providers to see about whether we could come up with some form of vendor finance or some kind of funding partnership in order to progress the development of the field. I'll get into some more detail about that in a while, but what we have managed to do is put together vendor finance contracts with some very big service companies, which has allowed us to then get to a point where we can hopefully very soon develop the field. You may all be aware that our shares were readmitted to trading just a few days ago, and that was on the back of raising $9.6 million of equity capital to follow the vendor finance package that we've put together. So that will allow us to progress with the drilling of the next well on the field, the Aurora 2, which will essentially be very, very similar to the original Aurora 1 well that was drilled 30 years ago. The idea here is we want to get to production as soon as possible, prove this asset, so we can then progress the development of the field on a more full basis. Key to all of the work that we've done over the last 2 years really has been the formation of strategic partnerships with some global leaders. And one of the first parties to that was BP. We've some very, very good contacts in the company. BP as a company has lost out over the last 10 or 15 years to the likes of Glencore, the likes of Vitol, the likes of Mercuria, and now has a very much strategic intent internally to secure more offtake, particularly in West Africa. And as a result of that, BP is prepared to work with companies like ourselves, even though our asset is relatively small, because of the opportunity and the platform that gives them to build more offtake in future. So from a very early stage in these strategic partnership discussions, BP has been incredibly constructive and incredibly helpful. What we've done is we've agreed to give them the offtake from the fields, so they will essentially lift our crude for at least the first 5 years. In consideration for that, the company has offered to prepay us up to $10 million in advance of any liftings that we will be allocating to them. The benefit of that is it really helps us with the working capital management on the field. The second major strategic partnership we formed was with a company called COSL, China Oilfield Services Limited. This is a subsidiary of the Chinese National Offshore Oil Corporation. They have a fleet of high specification jackup rigs, and what they've agreed to do is to provide us with a rig to drill the well on deferred payment terms. So we will pay them a deposit up front, and then a portion of the cost of the well, the cost of the drilling, and all of their profit and bonuses get deferred up to 6 months after first production. So they are effectively taking some risk in this well. In addition to the partnerships with BP and COSL, we've agreed terms with Schlumberger, who will provide integrated service management to the well. So essentially they will do pretty much everything from the platform down, from the rig down. Similar to the contract that we've agreed with COSL, we will pay a deposit, a proportion of their cost up front, and a significant part of the remainder of the cost of their services will be deferred until after first production. In addition to that, Add Energy, a Norwegian company, they're a well management company. They drilled quite a few of the Tanzanian wells for Ophir and BG a number of years ago, which were obviously very successful. They will supervise the drilling of the wells for us. So in line with the terms we've agreed with Schlumberger and with COSL, each of these companies is effectively taking some financial risk in this first well. They've accepted that because we're replicating the original discovered Aurora 1 well, it's quite a low risk proposition. We are simply seeking to target the reservoir that flowed to surface in the first place. I think one of the most interesting elements of the strategic partnerships we put together over the last number of months is a financial partnership we put together with a Swiss banking group called Rail. What Rail provide is structured finance solutions to different industries. And really what is behind this new product they're offering is the concept of securitization. So essentially what they're doing is saying, we have high degree of confidence that you're going to be able to produce oil. We're able to actually secure some visibility on prices that you can secure for that oil right now. We also know what your profile of cash flows will be for the next 12 months. On that basis, we can use securitization to bring forward a lot of those cash flows in order for you to then pay for the work that you want to do. The fact is, this is non-dilutive funding. So what we can do with this is, having raised the $9.6 million of equity, we will be able to fully fund the entire development of the Aurora field, involving 4 to 5 wells potentially, without having to come back and raise more equity. We're using the cash flows from the field to drill these wells. And that's essentially what this contingent liquidity facility is allowing us to do. So the asset itself, I've gone through some of the details. The original well, as I say, flowed 2,700 barrels a day to surface. We've got quite a lot of the work done already. Site survey is already completed. The environmental impact assessment work has already been done. We've got all of the permits. We're pretty much ready to go. We've identified the rig that we want to use. Once we've paid the mobilization fee to Coastal, that rig will be on its way to Nigeria so we can spot the well. We imagine, or we're expecting rather, that once we've spotted the well, it'll take about 6 weeks to get the well into production. We are, as I said before, we're entitled to market 100% of the hydrocarbons from the field. We also get 88% of initial cash flows while we're invested in the field. So we are responsible for funding the drilling work, but we will get 88% of all the cash flows as we're recovering that cost. In terms of the original well itself, the Aurora 1 well, it intersected 7 hydrocarbon-bearing zones. It was completed eventually in the G sands at the bottom. Those flowed almost 2,300 barrels of oil to surface during a drill stem test. There was also hydrocarbons recovered from 3 zones within the D sand intervals, which are slightly shallower. So essentially, what we want to do is replicate that well as much as possible. So it's a very, very low risk proposition. This is the plan for the well. You can see here the original Aurora well, 1 well was here. We will effectively drill the Aurora 2 well almost next door to it. And as I say, a fairly straightforward vertical well. It will deviate slightly towards the bottom. We will complete in the G sands, which is down at the bottom here. We will also test the D sands at this interval here. And the idea of testing the D sands is to confirm that the hydrocarbons are there. The second well we drill will basically penetrate the D sands. There's something like 800,000 barrels of estimated recoverable resource in oil rather in the G sands. There's something like 5.5 million barrels of estimated recoverable oil in the D sands. So that's clearly pretty important. So Sirius, why are we different? What do we do different? The big issue in Nigeria is not the subsurface. There's 40 billion barrels of proven reserves in Nigeria. The country is producing almost 2 million barrels of oil every day. So there's no question about whether there's oil and gas there. The issues in Nigeria are effectively above surface. How do you manage all the risks of operating in that country? And that's something that we're very focused on. Ideally, we like to focus on assets that are offshore and ideally in shallow waters. That means that we don't need to use onshore infrastructure. And other companies have had problems with that. We insist that when we farm into an asset, we operate. So we take responsibility for operations. We're not reliant on, we're not dependent on a partner to help us with those operations. We deliver the entire project plan. Also, we require full offtake rights for the hydrocarbons. So we want to be in a position where we can ensure we don't have any problems with liftings, we don't have any problems with payments. And that's allowed us to form this strategic partnership with BP. So when we sell the crude, we sell to BP, BP pay us. There's no delay between lifting and payment. As you've seen already, we formed these strategic partnerships with global leaders in the service industry. So we're quite comfortable that essentially execution will be good. All of the teams from Schlumberger, from Add Energy, from Coastal are lined up, ready. Our work plan has been fully developed now, and basically we're ready to go. Finally, when it comes to potentially acquiring, farming into assets, we're very diligent about the work we do on potential partners. There are often challenges in Nigeria working with partners who are difficult, obstructive, incapable of funding their share. So beyond Aurora, and let's call a spade, Aurora is a relatively small asset, 24 million barrels of oil equivalent. We do believe there is some upside. The high case, as per the CPR, the rock flow provided us, is about 43 million barrels, which is not too bad. But it's the opportunity to take this model, to take this platform, to take these partnerships that we've put together forward to effectively acquiring more assets and building a bigger portfolio. So what are the options that we have? Well, firstly, we do have a close relationship and effectively a strategic partnership with Owena Oil and Gas, which is the state-owned company from Ondo State. In 2003, the first marginal field bid round, all of the oil-producing states were awarded an asset. And as you may know, there's a new bid round expected in the next few months. And it's highly likely that each of those oil-producing states will be awarded an asset. We, via our strategic partnership with Owena, will effectively have an opportunity to farm into that asset on similar terms to Aurora. The bigger players, as more bigger discoveries have been made in deeper waters, the likes of Chevron, the likes of Eni, the likes of Shell are beginning to seek to divest some of these assets that they have, which are perhaps marginal for them, but would be significant for us. We have a close relationship with Chevron, given that our asset is originally a Chevron asset, so we're pretty confident there'll be plenty more assets to come via those relationships. I would say that we are in discussions on a couple of new assets. We would hope that we'll get to a point where we can make a decision on those pretty soon, and these are likely to be pretty significant in the context of the portfolio that we've got. So, why Sirius Petroleum? Well, first point, we have an asset that we believe we can get into production very soon. The rig should be on the way. We expect to spud the well probably March. We can be in production by April. We would have liftings within 3 months of that. So we will be generating significant cash flows by the first half of next year. We're very happy with the funding structure we've put together with our strategic partners. Vendor financing from the service companies, which again, in our view, is a validation of the asset and a validation of our strategy. We're very happy with this contingent liquidity facility structure we've put together as well, because we then can fully fund the entire field development without having to come back to equity shareholders. I would say, obviously, that I think we're attractively valued from an equity perspective. If we look to 2018, on the assumption that we will deliver the production rates that are in the CPR, given where oil prices are right now, we could be producing as much as 4,000 to 5,000 barrels per day of oil on average through 2018. That would imply revenues of in excess of $100 million next year. Remember, we have 88% entitlement to that. With operating costs at a relatively low level, with royalties, which are effectively preferential for marginal fields, you could get an idea of the kind of cash flows that we should be generating in 2018. So it's an exciting time for us as a company. Having got this funding done, we can finally get on with operations, get into production, and start building an interesting portfolio. And as I say, plenty of opportunity in Nigeria, and hopefully we're well positioned to take advantage of that. Thank you.